Welcome back. Markets are under pressure this morning. The Bank of England raised interest rates for the second time in a decade. But really what's undermining futures this morning is speculation that we are seeing this spat with China escalate. Dow Industrial is expected to be down about 150 points. The Nasdaq down 55 right out of the gate. Of course, yesterday the Federal Reserve kept interest rates unchanged, but also highlighted the strength of the American economy at the end of their two-day meeting yesterday, suggesting that we will see further rate hikes in the future, perhaps the next meeting. Joining us right now to talk about all of that, Chief Investment Officer for OppenheimerFunds, Krishna Memani, is here. Krishna, good to see you. Thanks for joining us.
Thank you.
Your take on where we are in markets right now?
I think the markets are still relatively well priced. The underlying economy on a global basis is actually doing quite well. Earnings growth in the U.S. is going to be around 15% even without taxes, or at least was 15% this quarter. Slows down a little bit, but not meaningfully. So everything is good. If we can get beyond this tariff issue, the markets are ready to run.
Do the tariffs cut into margins at some point and change that earnings story?
It cuts into margins a little bit, cuts into growth a little bit, but doesn't change the picture meaningfully.
I'm wondering, long term, there's sort of this debate on, we talked about on the show, whether this is a sugar high coming out of tax cuts and deregulation, or you're looking at a long-term really higher level of growth in the U.S. Which way do you come down on that?
I think there's certainly some element of sugar high. You know, when you have a large amount of stimulus going through the economy, you get that high. But even beyond that, we are talking about 2% growth, which is not the fantastic growth that everyone wants, but it's still very reasonable growth in the post-crisis environment. And earnings, on the other hand, are doing very well. Even, as I mentioned before, even without tax cuts, the earnings in the second quarter probably grew around 15%.
So you're still seeing new normal long term, 2% growth, no better. You don't think the tax reform is a game changer?
Well, tax reform is a game changer if the pace of capital investment increases meaningfully, and on the back of it, productivity increases meaningfully. We won't see that for a while. Okay. You know, productivity takes a long time for it to kind of manifest itself.
But
so
we have
will
seen
see
business spending pick up quite a bit as a result of the rollback in regs and the cut in taxes.
Well, capital spending has picked up. It's probably the highest level it has been, but you would expect capital spending to pick up at this point in the cycle anyway.
Okay.
I'm sure there's some positive impact from taxes, but it hasn't changed the game meaningfully just yet.
So I see.
Is there a specific sector, when you look at the market broadly, if you were to narrow it down, are there sectors that you look to outperform the rest of the market throughout the rest of the year?
We still are focused on tech and companies and sectors that can deliver significantly better growth than the underlying economic growth trend. I think tech is the top of that list. They are executing, and I think Apple earnings that just came out kind of indicated that. You know, Facebook was a bit of a shocker to the system, but I think between Google and Apple, we are reestablishing the earnings trend for tech.
Are they overbought? Said another way, are they just priced too high right now, or is there still room to grow for the
I think there's still room to grow. All of these tech companies are executing as well as anyone can expect.
Yeah, but then there's higher interest rates. The 10-year Treasury topped 3% yesterday. First time in almost 2 months that we've seen that. There was a moment in this market when you hit 3% and there were real worries, stock market sell-off. Do you worry still about 3%?
Well, no, I think 3% is just a number. I think what you're really talking about is, are rates going to be high on a sustained basis over the next 2, 3, 5 years? And our outlook is that's probably not going to be the case, primarily because of our outlook for 2% underlying trend growth. And at that level, I think we are talking about 3% being on the higher end of rates as opposed to rates moving up meaningfully higher.
But just to connect this story with the story of the day, and that is the threat that we're going to slap a 25% tariff on an additional $200 billion of imports from China. The thinking is this adds to inflation pressures. There's a big difference between a 10% tax on these imports and a 25% tax. It adds to inflation pressures. It forces the Fed to raise rates even quicker. It could send longer-term interest rates up. This is at a time, and this is on the front page of the Wall Street Journal, deficits prompt the Treasury to boost borrowing. So, again, we're not dealing with the debt. And this is a looming crisis that people are concerned about. And, again, you stir up those inflation pressures even more with these tariffs. You better look out below in terms of stocks.
Oh, absolutely. I think inflationary pressures increase in some parts of the economy, but at the at the margin, it doesn't change the dynamic dramatically. But the point about deficit is extraordinarily good one, which is if you want to reduce trade deficit meaningfully, what you have to do more importantly than tariffs is to reduce your fiscal deficit.
Right.
That, at the end of the day, is going to be the driver of lower trade deficit.
That means pull in the spending.
Yes, pull in the spending and basically not have the stimulus when the economy is doing reasonably well, especially on the spending side. Tax cuts, you can make an argument that it leads to better productivity down the road, but spending deal on top of taxes, tax cuts doesn't make any sense.
Krishna, before you go, tomorrow we got the July jobs number out. What are you expecting? Will we see a good number?
Well, yes, the underlying economy is doing well. The expectations around 200,000, and I think we'll be there, give or take, of 10, 20,000 this way or that way.
All right, 190,000 jobs created is the estimate on the unemployment rate at 3.9%. Krishna, good to see you this morning.
Thank you.
Thanks so much. Krishna Memani there.